Welcome to the Hurst Trading Room Live. My name is David Hickson and today is the 3rd of October 2016. A big welcome to everybody who's joined us live. We have people from all over the world. It's wonderful to see you all here. Thank you so much for joining me. Before we take a look at the markets, we need to, of course, take a look at our disclaimers. Please make sure that you have read and understood these disclaimers before moving on. If you're watching the recording, you will be able to pause at this point, so you should probably do that to familiarize yourself with these disclaimers. In today's webinar, I'm going to be speaking about some currencies, some forex pairs. It's a little bit of a change of pace because these webinars recently I've been analyzing in great depth the US stock markets. And today we're going to be not looking at the US markets at all. We're going to be taking a look at some currencies. And what actually happened was there is a new intraday Hurst trading room, which I'm very excited about. It's been put together by David at Trading Hurst and Derek Fraser, very experienced Hurst analysts and sentient trader users who are sharing their intraday analysis online. So you can tune in and watch what they're doing. I would strongly recommend it. It's a lot of fun seeing people working with their Hurst analysis intraday and speaking about what they think is happening in the markets. It's a great combination because one of the presenters is based in the UK and one of them is based in the US. So they're covering both UK or European markets and the US markets. So if you get a chance, you must go along and take a look at that. But I was in that room on Friday, I think it was, and somebody suggested that I take a look at the British pound to US dollar in today's webinar. And so I thought that seemed like a really good idea. And at about the same time, somebody suggested I take a look at the Australian dollar against the New Zealand dollar, because the cycles in that are really quite nice and clear at the moment. So that's what we're going to do, is we're going to look at both the British pound to US dollar and the Australian dollar to New Zealand dollar. And the reason why I'm going to look at both is because I want to make a little bit of a point about something that I call relative space, the relative value space. What is the relative value space? Well, everything that we trade, of course, has a value expressed in terms of something else. So if we're trading stocks, then we're buying stocks in a company, and those stocks are valued according to the currency that we use to buy those stocks. So if you're going to buy stocks in Apple, then in fact what you're doing is you are trading the relative value of the Apple stock relative to the value of the US dollar. So if Apple stock goes up, then it is increasing in value relative to the US dollar. And if it goes down, then it's decreasing in value relative to the US dollar. Of course, we're familiar with that concept when it comes to stocks. What is really interesting, in my opinion, about currencies or forex pairs is that each forex pair, as its name implies, is a pair of currencies, and each one of those forex pairs is a comparison between the values of two currencies. So what happens is when we're looking at the British pound to US dollar, such as this chart that you see in front of you now, which is the price movement of the British pound to US dollar going back to 1976, when we look at a forex chart, then we are looking at the relative value of the British pound against the US dollar. We're not looking at the absolute value of the British pound, nor are we looking at the absolute value of the US dollar. We're looking at the relative value between those two currencies. And I am intending to loop back at the end of this webinar and tie this all together, because forex pairs give us a very interesting opportunity, because we're able to analyze the relative value of all these different forex pairs, and we can work out which currency generally is the currency where we would like to be investing, or where we would like to have our money. And in fact, for many years now, I've managed some of my money purely on the basis of not trading it, but simply shifting it from a bank account in one currency into a bank account in a different currency. You don't have to do it very often, and the bank charges are generally fairly low. They're much lower than trading charges, but it's a very interesting way of benefiting from an analysis of the relative value of these currencies. So I'm going to come back and speak a bit more about that right at the end of today's webinar. In the meantime, I see several more people coming in. Welcome to all of you. Hello to Richard, who's just joined us from Canada. Good to see you all. Let's take a look at the British pound to US dollar. This is the chart that you see on your screens at the moment, and this is an analysis going all the way back to 1976. I wanted to start with a really big picture in the British pound to US dollar. I'm not going to go through such a big picture with the other currencies that I'm going to be looking at, but with the British pound to US dollar, I wanted to make a very important point, and that is revealed by this very long-term chart. So what are the highlights of this analysis? Well, first of all, we're looking at a trough analysis. In other words, Sentient Trader has performed an analysis of the troughs in this market. In a moment, we're going to be taking a look at the peak analysis as well, which is a new feature that Sentient Trader is able to do. But this trough analysis shows us that there was an 18-year cycle trough over here. And that was back in, was it early 1985? I think my eyes aren't really as good as they used to be. I think that's early 1985. Then there was another trough of the 18-year cycle over here in 2001. And what is happening now is that the market is heading down into a trough of the 18-year cycle, the next trough of the 18-year cycle. So in terms of the bigger picture, the British pound valued relative to the US dollar is moving down into a trough of the 18-year cycle. And we're going to have a look at it a little more detail in terms of how close it is getting towards that trough. But let's just do some measuring here and work out how long these cycles have been, how long they've been running. We can do that using the measuring tool here in Sentient Trader. So you can see that that first 18-year cycle from 1985 to 2001 was in fact only about 16 and a half years, give or take a little bit. And so it was running fairly short for an 18-year cycle, but not too short to make it impossible. So we had 6,011 days in that 18-year cycle. And now if we measure 6,011 days moving forward, also about 16 and a half years, then you'll see that takes us to about the middle of 2017. You probably can't see it, so you'll have to take my word for it. But that's in about the middle of 2017. So the sort of bigger picture here is that we are watching the British pound decline in value relative to the United States dollar and drop into an 18-year cycle trough, which is expected in about the middle of 2017. Now, let me zoom in and we can take a look at the most recent 9-year cycles, and we can measure those as well. So from the trough in 2001 to the next 9-year cycle trough, which was right at the beginning of 2009, the British pound to US dollar moves with a great deal in common with stock markets around the world. It's a really interesting thing. I don't know why, probably because between them the British pound and the United States, not the British pound, Britain and the United States are sort of major movers in terms of world economy. But you often see common elements between the British pound US dollar and stock markets, and of course there was a very strong decline in the British pound US dollar in 2008, as there was in stock markets around the world. Anyway, that 9-year cycle came in fairly short at about 7.6 years. And I'm going to come back to that number again, because seven and a half years turns out to be a fairly interesting cycle or time period in currencies. And you'll see that I'm going to be working with an analysis that actually uses that as its default. But in this case, the software has found a 9-year cycle, what we call a 9-year cycle, and it has found it to be of 7.6 years in length, which is again short, but not too short. If we assume that the next 9-year cycle will take another 2,776 days, then that meant that the next 9-year cycle trough is due round about now. In fact, if we zoom in and look a little more closely, you'll see it was due a couple of months ago, the next 9-year cycle trough. That's based purely on the fact that the most recent 9-year cycle was of that length. Of course, cycle periods vary, so each example of a 9-year cycle will have a slightly different cycle wavelength, and so we don't expect it to come in exactly to the day the same length as the previous cycle, but it gives us a good indication. So the bottom line is that the British pound to US dollar is now descending into an 18-year cycle trough. And how far has it proceeded into that 18-year cycle trough? Well, we would expect two 54-month cycles to elapse, and here is the first one, and it was a length of 1,621 days, 53.3 months, almost 54 months, so that's looking good. It's fitting our nominal model, the model that we're using to perform this analysis very closely, so that gives me a good deal of confidence in the model, the cyclic model that we're using. 1,621 days into the trough in, I think that was in July of 2013, and if we count the same number of days moving forward, then you will see that takes us into sometime late 2017. Okay, there is a tendency amongst many people, and I count myself amongst those people. There is a tendency when the market is dropping down into a really big cycle trough to start getting a little bit jittery and start saying, oh, the trough has happened. You start expecting it before it's due. Of course, you must be standing by for that trough because it's a very important trough, and we need to be ready for it when it happens. But it's more important that you don't jump into long trades prematurely just because the market's gone down so much. You think, gosh, it can't go down any further. So I'll speak for a moment about how much further this market could go down, and we'll look at another new tool in Sentient Trader, which is quite an interesting tool for projecting how far markets can go. I see David at Trading Hurst says he thinks there's an 18-month low due soon, and that's the final of the 9-year cycle. Well, let's have a look at what this analysis says. Of course, there are various different analyses, and I'm going to be showing you two different analyses actually. But if I zoom in over here, then you can see that this particular analysis tells us that the 18-month cycle trough is due soon, but that is only the second 18-month cycle in the current 54-month, 9-year and 18-year cycles. So we're expecting an 18-month cycle trough to form soon, but there will then be one 18-month cycle left before the really big cycle trough forms. Now, this is something that we could debate, and it'll be a fascinating debate, but I don't think we should spend too much time debating it. The point is, as David at Trading Hurst says, this next 18-month cycle trough might turn out to be the 9-year cycle low as well. And that would imply, if it is, that this 54-month cycle from over here into the next 54-month cycle trough has broken down into two 18-month cycles, or in fact, they would be longer than 18 months. It would probably be about 20 months, 2 cycles instead of 3, which is an interesting concept that I'm going to be coming back to in the webinar, because it is something that I believe happens. It happens less frequently in stock markets, and it happens more frequently, in my opinion, in forex markets. And that is that the harmonic ratio between the 54-month cycle and the 18-month cycle, or at least those cycles in our list of cycles, those the cycles in that position in the nominal model, sometimes have harmonic ratios of 3:1 and sometimes have harmonic ratios of 2:1. It's something I've mentioned before when I've discussed the euro to US dollar, because the euro to US dollar seems to have been beating with a slightly different rhythm, which has two 18-month cycles, or what we would call 18-month cycles. They're a little bit longer than 18 months. They're a little over 20 months. So two 20-month cycles for every one of the bigger cycles. So that is an interesting idea, and it's definitely something that we need to keep in the back of our minds. So the market is probably coming down into an 18-month cycle low, there might be one more 18-month cycle to go before the big 9-year and 18-year cycle trough, or that might be it in terms of the big low. So we need to be standing by and we need to be watching it. But now I'd like to point out a few other things before we take a look at some different analyses. First of all, let's measure these 18-month cycles. Here's the first one, and you can see it's stretched very long to 21.1 months. That's a really long 18-month cycle. Okay, and then we had this move down to the low following the Brexit announcement. So that low was in the first week of July, if memory serves me correctly, and we had a low point forming then. And do you see that the low point that formed in July was in fact at the 36-month mark? So I am going to play devil's advocate again and throw another idea in here for us to consider, and that is that we had a very stretched 18-month cycle forming a low over here, and then we had a compressed 18-month cycle which actually already formed its low on the 5th of July. Now, let's quickly zoom in and have a look and see what's been happening since the 5th of July. Well, we'll give it a little bit of space. Let's turn off these semicircles. And you might say to me, how is it possible that an 18-month cycle trough formed on the 5th of July when nothing has happened to the market since then? Because it hasn't really bounced up at all. You can see this little M shape over here. It really hasn't bounced up at all. Surely it's impossible that the 18-month cycle trough formed on the 5th of July. I don't think it's impossible. I don't wish to throw too many analysis possibilities your way, but I don't think it's impossible that the 18-month cycle trough did form then. Why would it have had such a miserable effect on price movement since the 5th of July? One possible reason is because the 54-month cycle is pressing down, the 9-year cycle is pressing down, and the 18-year cycle is pressing down. So all of those cycles are pressing down. When a market approaches a really big magnitude trough, your analysis can become really quite difficult to resolve, because your bounces are just not very impressive because there's so much bearish pressure. So you often end up really struggling to position your troughs. And often under those circumstances, the best thing to do is to stop worrying too much about the troughs. We know what we're expecting in terms of the troughs. I hope I've made that clear now. But maybe we should now turn our attention to the peaks. So let's do that. And I see Peter is saying, would you rather use 18-month VTL or FLD breakout to say it was through? So Peter, that's an interesting question. One of the dangers with a VTL is that a VTL is very closely based on your analysis, because of course a VTL is based on the peaks and the troughs that have been found in the analysis. If you have incorrectly identified troughs or peaks, then you're looking at a VTL which isn't actually the VTL that you thought it was. Okay, if you think you've joined the trough of two 18-month cycle, if you've joined two 18-month cycle troughs or peaks, and they are not in fact 18-month cycle troughs or peaks, then the VTL can be misleading. The VTL will usually give you the better entry, but the FLD is more reliable. So I would use the FLD, but I would not wait until price reaches the 18-month FLD. You can of course use shorter cycle FLDs and VTLs to time your entries, or to provide evidence that a particular trough has formed in the market. The other thing that I would really strongly recommend when price is coming down into a very big magnitude cycle trough is not to try to trade the bounce out of that first trough necessarily, unless you're really quite experienced at it. I would wait to see a shorter cycle, a bullish shorter cycle shape form first. So in other words, the first 40-week cycle, as David at Trading Hurst says, or the 40-day cycle. What cycle you're watching depends on your level of confidence in your analysis. Hope that makes sense. So let's quickly have a look at our peaks over here in terms of the British pound to US dollar, and then I will turn on the semicircles so that we can see what's happening with the analysis of the peaks. Okay, I'm not going to spend quite so much time speaking about the peaks, but there is a very big 18-year cycle peak over here, and that was in 2007? I think towards the end of 2000 or was it, yeah, towards the end of 2007, that big 18-year cycle peak. And then there was a 9-year cycle peak probably over here, which was in 2014, I think I'm correct in saying. So so there we've got our peaks happening. Now the British pound to US dollar is a really interesting currency because it has very clear troughs usually and peaks. Most instruments that you analyze will have clear troughs and probably rather murky peaks. If it's a stock, for instance, because stocks, as you probably know, have synchronized troughs and they don't have synchronized peaks. So you end up getting very sharp isolated troughs, and you tend to get clustered and rounded peaks. But the British pound to US dollar gives us very nice clear troughs, and it also gives us very nice clear peaks. Okay, so it's an interesting instrument, and the peak analysis in the British pound to US dollar is, in my opinion, as valid as the trough analysis. So I find it quite interesting to look at both of these. Now, following this 9-year cycle peak, which formed in 2014, price came down, and you can see, according to this analysis, it formed its first 18-month cycle peak over here in March of this year. It's quite interesting that it isn't positioning it up at the peak, up at the top, following the Brexit announcement or preceding the Brexit announcement. The point is that I think that the peaks have seen the 18-month cycle peak. Whether it's positioned over here or whether it is positioned over there at the Brexit announcement is debatable, but the point is that the peak analysis is still giving us downwards momentum on the 18-month cycle. So the 18-month cycle is giving us downwards momentum. We are, of course, expecting a trough in terms of the momentum of the 18-month cycle in the peaks. We're expecting a trough which is likely to be around about the time of this trough that we're expecting to come fairly soon. Now, I mentioned that there's a new tool in Sentient Trader that you can use to give you an idea of just how far these moves can go. It is and what I would describe as an auxiliary tool. It's not fundamental Hurst. It's not. It wasn't something ever explained by Hurst or described by Hurst, but it was a tool that I found useful. It was something I discovered in my work with Hurst cycles, and it's something called a zigzag. So I'm going to display the zigzags here for the. Let me display the zigzags for the 18-year cycle. What is a zigzag? Well, I noticed that when you have a trough and a peak analysis, that what happens is the price moves from a trough of a particular cycle, in this case the 18-year cycle. It moves from the trough of the 18-year cycle up to the next peak of that same cycle, the 18-year cycle, and it tends to do it in a zigzag motion. So it goes like that, in a zigzag. I'm sure you know what a zigzag is. Then it moves down to the next trough of the 18-year cycle, and it does that also in a zigzag. There we go. Then it moves up to the next peak of the 18-year cycle, and it does that in a zigzag. And then it moves down to the next trough of the 18-year cycle, which is the trough that still lies ahead of us. And here's the important point, it will do that in a zigzag. So it comes down, then it goes up, crosses the main cycle line, and then comes down again. So why are these zigzags useful? Well, you can use zigzags to very roughly generate a bit of a target. They're not perfect targets by any means, but they are useful to bear in mind, and sometimes they turn out to be absolutely perfect. Sometimes they turn out to be not quite as accurate as the other methods that we have for generating targets, such as FLDs and so forth. But the thing that I wanted to point out to you here is that the way that zigzags usually work is you get a strong move in the direction of the main cycle line, which is this dashed line over here, which is the sort of center of the zigzag. So you get a strong move down, which is, I suppose, the zig, and then you get what I call a cross line, which crosses up above there. Then if you bisect that crossing line, then you can generate a target down to where the market is expected to move in the zag. Is that the zag? There's a zig and then a sort of a cross line and then a zag. I'm not sure if that's the correct terminology, but my point is that the past action that we've seen in this current 18-year cycle move indicates that there is further weakness ahead for the British pound to US dollar. So I am not sitting here, getting ready to jump onto a long trade just yet. As David at Trading Hurst says, it is possible that this 18-month cycle trough is also going to be the 9-year and 18-year cycle troughs, but I'm going to need a bit of evidence before I'm willing to jump into it and believe in that. So the longer term picture which this chart shows us is that there is probably still further weakness ahead for the British pound to US dollar. And I see David is saying that he prefers the 3-to-1 ratio between the 54-month cycle and the 18-month cycle. So that brings me very neatly to the next chart that I would like to show you, which is here we go, which is actually I have less data here, and it's a slightly more detailed analysis. I've focused a little more on what is happening in the more recent time frame. And so if we have a look at the troughs, and if I zoom in here, you can see really a very, very clear rhythm, in my opinion. You've got the 18-month trough over there, then you've got the 18-month trough over there, then the next one over there. Then that rhythm sort of stretches a little bit, but we've still got a fairly good rhythm going there. And so the 3-to-1 harmonic ratio for the troughs works very well in my opinion. And as long as a nominal model is working, I don't really see any particular reason to change it. You'll notice that in this analysis, Sentient Trader has positioned the 18-month cycle trough over here on the 5th of July. As I mentioned, it looks unreasonable, but if you measure the length of time between there, you will see it is almost exactly 36 months. And so therefore 2 18-month cycles should have been expected to have elapsed in that time. Perhaps something was happening during this cycle over here which caused this cycle to stretch, and then this cycle over here compressed. Perhaps. I'm not saying that this is definitely the absolute correct analysis with the 18-month cycle trough on the 5th of July. But now what I'd like to do with this analysis is take a look at the peaks. And let's over here show the peak analysis. And let's focus a little more on the rhythm in the peak analysis. So we had a big 54-month cycle peak over here back in 2007. And then we've got an 18-month cycle peak and then another 18-month cycle peak. That looks quite reasonable. Then we've got an 18-month cycle peak, but that must also, of course, be the 54-month cycle peak. So far, so good. That's not impossible. That could easily be the 54-month cycle peak. But it's what follows that action that worries me slightly, because following a 54-month cycle peak, we would expect to see a bearish cycle followed by a neutral cycle, followed by a bullish cycle when you're speaking about peaks. But what we did actually see was a bullish cycle up to this 18-month cycle peak over here, followed by a very bearish cycle up to this peak over here. And now we're getting what looks like it's going to be an even more bearish cycle. There's something not working in terms of the peaks. I hope that you can see that. When you get a peak of a cycle, such as in this case the 54-month cycle peak, you generally expect a sort of a symmetrical price action perhaps to happen around it, but we expect a sequence of 18-month cycles, which should in this case have been bearish, neutral, and then bullish to bring us up to this peak over here. Now, of course, it is possible that we're going to see a tremendous kick up here, and then we're going to end up with fairly symmetrical price action surrounding this 54-month cycle peak. That's not impossible, and if that happens, then we're going to have the long trade of our lives as the British pound pulls all the way up to this peak over here. But I thought it would be interesting to have a look at the peaks that have formed here and just measure the distances between them. So let's zoom in here and see. Let's turn off these semicircles. In terms of measuring the peaks, I like to just measure like that. You'll see that this the first sort of big peak there is at 21.1 months, and if I measure the next big peak, it's also 20.8 months, and if I measure the next peak, which is over there, that's about 20.2 months, and another one over here, that's 18.3 months. So out of those 4 cycles, 3 of them were over 20 months in length, and one of them was 18 months in length. I asked myself, is it possible that we're seeing an interesting situation develop here, whereby we have a situation like this, where you have only 2 cycles up to the longer cycle peak, and then we had another 2 cycles up to the next longer cycle peak. Okay, so of course you can build a nominal model to do that, and I won't bore you with the details. What I will do is simply show you what that analysis looks like. And so this is an interesting chart because I'm working with 2 slightly different nominal models for the trough and the peak analysis. This is something I find actually works fairly well for forex, particularly where forex goes through periods of time where your peaks are very nicely aligned and synchronized, and you get very clear peaks, and you go through periods of time where your troughs are very nicely aligned, you get good synchronized troughs, and it sometimes works really well to apply a different nominal model to your peaks to the nominal model that you're applying to your troughs. So I thought this was a really interesting analysis to show you. And you can see that there are only 2 18-month cycles for each of the 54-month cycles. In fact, the nominal model up at the top of the chart works with a shorter cycle. It works with a 7-year cycle as opposed to a 9-year cycle, but it gives us a really interesting analysis to consider. So let's sort of wrap this up and ask ourselves what's happening with the British pound to US dollar. In my opinion, the most likely thing that is happening is that the 18-month cycle trough did in fact form on the 5th of July. And we've seen a bit of a miserable bounce since then. And what we're going to be seeing now is a protracted move down to a 54-month cycle trough, which will also be a 9-year cycle trough and an 18-year cycle trough towards the end of 2017. So in my opinion, that is still the most likely scenario. However, it is also possible that we should be standing by for the 9-year and 18-year cycle trough to form early. And perhaps this 18-month cycle still lies ahead of us, as was indicated in that first analysis. And so we're going to watch the market coming down into the 18-month cycle trough. As the market bounces out of that 18-month cycle trough, I'm going to be watching with great interest. Because if it bounces with tremendous strength, then it is very possible that that 9-year and 18-year cycle trough has formed in the market. So it's something that we need to be standing by for. But it's one of those really interesting situations with Hurst cycles where we know that there is an 18-year cycle trough expected in about a year's time. Now, 1 year out of 18 years is a fairly small percentage. What is it? A little over 5%, sort of 8% or something. So, so it's not entirely impossible that the 18-year cycle trough could be forming now, and so we need to keep our wits about us and watch what happens. What do I mean by watching what happens? Well, I don't mean setting stop orders, you know, for your big 18-year cycle trade. But what we will be doing is watching the cycle shapes that form. Let me quickly show you a glimpse of the composite model line. The composite model line takes all of the cycle information that it has, and it assumes that the cycles keep beating with the same rhythm and the same amplitude over time, which is a flawed assumption in the first place, but it provides us with an interesting visualization, if you like, of what is expected according to this analysis. So according to this analysis, you can see the market's expected to come down and form a little trough over here at the end of October or November. And in the other analysis, that trough would be the 18-month cycle trough. But then the market is expected to effectively continue lower all the way down to this 9-year or 54-month cycle trough expected towards the end of 2017. So that is what is expected most probably from the British pound to US dollar. And there are two possibilities there for what might be happening. So I'm definitely expecting the British pound to keep losing value against the US dollar. I'm going to be watching the trough, and let's just zoom in here. I'm going to be watching this trough, and let's put that line back up again. This trough over here, I'm going to be watching that quite carefully, because if it's not a trough of the 20-week cycle, then it will be a trough of the 18-month cycle. And I'm going to be watching this bounce out of that trough very carefully. As we've mentioned already, I wouldn't recommend jumping into the trade immediately. I like to watch the first 40-day cycle at least. And if we get a good bullish M shape for that first 40-day cycle, then that would certainly give us a good opportunity to enter into a long trade. So that's what's happening in the British pound to US dollar, in my opinion. Let's now quickly take a look at the Australian dollar to the New Zealand dollar and see what's happening there. And then I'm going to sort of bring everything full circle, and let me see what's going on here. Oh, there we go. Okay. And make that window full. Okay. I'm going to bring everything full circle and speak about the concept of the relative value space again. So this is what we have in the Australian to the New Zealand dollar. And you can see that according to this analysis, I have marked this, let me just slide this chart up a bit. I have marked this very prominent trough over here. I've actually pinned that trough as a trough of the 54-month cycle, because I think that is what is happening here. And you notice that off to the left edge of the chart, we get some sort of unresolved, really, really prominent troughs over there. But because I don't have enough data on this particular chart to look back into the past, I haven't bothered resolving that, and I haven't worried too much about it. As far as I'm concerned, this trough over here is probably a trough of the 54-month cycle trough. And since then, we've seen a nice and very clearly shaped 18-month cycle. And so let's zoom in on that. That has developed. Let's turn off the semicircles and we'll turn off the peaks for now. Come back to the peaks. I've had to do quite a lot of pinning to get this particular cycle to work, as you can see, because Sentient Trader was inclined to position that as a trough of the 18-month cycle. We could debate it and we could discuss it, but in my opinion, this is almost certainly a trough of the 18-month cycle, which is formed over here recently, sometime in September, earlier in September. So let's zoom out again, because I'm focusing in today's webinar on the longer term picture. And let's quickly have a look at the peak analysis here as well for the Australian to New Zealand dollar. And you can see that the really prominent peak over here was in, I think that was in 2011, and that was almost certainly a peak of the 54-month cycle. Sentient Trader hasn't positioned the 54-month cycle because it doesn't have enough peaks of the 18-month cycle to really resolve beyond any question of doubt where that 54-month cycle peak is. But I'm going to be a bit cheeky, and I'm going to say that over there is a peak of the 54-month cycle, which means that the next peak of the 54-month cycle using a harmonic ratio of 3:1 is this peak over here, which was the peak in 2015. And so that looks very reasonable to me, that we then have a 54-month cycle over here. And now you'll notice the interesting way in which these two analyses work together. Price will tend to move from a trough of a cycle up to the peak of that cycle, and that is indeed what happened, in my opinion, over here. And let's turn off the semicircles. So here was a move from a trough of the 54-month cycle up to a peak of the 54-month cycle, which is over here. And so that's why we got that strong move upwards in price, because of the move from the trough to the peak of the 54-month cycle. Okay, so what happened? What has been happening since then? Well, price has fallen down from the 18-month or 54-month cycle peak down to this trough over here, and it's come back up again and come down into the 18-month cycle trough. And here we have a very perfect M shape. Isn't that a very, very beautiful M shape? It's not a particularly bullish M shape, which is slightly worrying. It has an early peak, as you can see. The highest price is up here on the left, and it has a slightly higher trough here of the 18-month cycle. So it's a mixed cycle shape, but nevertheless, I think that this analysis is a fairly good one and describes quite accurately, because of these really very, very clear and very nice cycle shapes that are happening here. So what does the Australian dollar to New Zealand dollar analysis tell us is happening in this currency pair? Well, if we zoom all the way out again, and let me show you the composite line, and let's see what is expected here according to this analysis. You can see that the composite line is showing we're getting a strong bounce up now from the 18-month cycle trough, and that's going to go into the 18-month cycle peak. But then price is expected to drop again, as you can see, because price is coming all the way down into the next 54-month cycle trough over here, way out in the middle of 2019. So first of all, these really long projections on the composite model line I don't think are very valid. So I'm not really terribly interested in what the composite model line says about 2019. But the important thing is that price is expected to bounce up here in the near term and reach this 18-month cycle peak, which is expected towards the end of this year. And then, of course, it's expected to turn down again and come down eventually to the next 18-month cycle trough. Now, following this 54-month cycle trough over here in March of 2015, we would expect to see a bullish M shape. As I've mentioned, we saw a fairly mixed M shape. Then we would expect to see a less bullish M shape. And so this whole sort of slight bearish slant to that picture probably does make sense in the context of this analysis. So that is what is most probably happening in the Australian dollar to the New Zealand dollar. The Australian dollar is gaining in strength through until the end of this year probably, at which point the New Zealand dollar is going to turn around and it's going to gain in strength relative to the Australian dollar, or the Australian dollar is going to lose in strength. So in my opinion, that's what's happening in these analyses. The interesting thing about working with forex, as I've mentioned, and one of the reasons I was particularly interested in speaking about it today, is that you can start working with the concept of a relative value space. So in other words, I'm not simply trading the British pound. I'm always trading the British pound relative to something else. And similarly, I wouldn't be trading just the Australian dollar. I would be trading it relative to something else. And so by having a look at an analysis of many different currencies, you can begin to work out which currencies you should really be focusing on. And so let's start trying to apply that and see how we can work out what we should really be doing with our money, or where we should be focusing in terms of what's happening with these currencies. So let's go back to the British pound to US dollar, and if I can get that workspace, there we go, and let's just zoom out and take a look at a bigger picture. Let's not worry too much about the short time frame. Short term, we're looking at a much bigger picture. So now I'm looking, with over a period of several months, many months, and the message that the British pound to US dollar pair gives us is that at the moment the British pound is losing value relative to the United States dollar, which it is going to keep doing until that 9-year and 18-year cycle trough comes in. Now, as I've mentioned, that 9-year and 18-year cycle trough is expected probably towards the end of next year, but it is possible that it might occur early. But the current status is that the British pound is losing value against the United States dollar. So the United States dollar is the stronger currency, and the British pound is the weaker currency. But now the interesting thing is that we don't know whether all of that movement is contributed by a decreasing in strength of the British pound or an increasing in strength of the US dollar. Because if the US dollar is increasing in strength tremendously and the British pound is simply staying constant, then we would get the same kind of chart, okay? Because the British pound would be losing ground relative to the US dollar. So we don't yet know which of those two situations is true, whether the British pound is increasing in value, I beg your pardon, is decreasing in value. It's certainly not increasing in value. Whether the British pound is decreasing in value or whether the US dollar is increasing in value. And so where do we put our money? If we had a choice, let's say you have a British pound account and you have a US dollar account, and let's say you have other accounts as well, an Australian dollar account and a New Zealand dollar account. In which account would you put your money? Clearly, you wouldn't want to put it in the British pound account, but would you want to put it in the US dollar account? Is the US dollar gaining in strength? So this is when we start considering the relative value of things. So far, we know the British pound is losing value relative to the United States dollar. But is the United States dollar generally increasing in its value? Well, let's go back to our Australian dollar to New Zealand dollar chart, and let's do the same thing with this chart and ask ourselves what is happening here. And again, I'm going to look at the slightly longer term here and speak over a much longer term. Here you can see the Australian dollar is expected to increase in value relative to the New Zealand dollar for the next few months. But after that, according to this analysis, it's expected to turn down. So if you're looking at a time frame of just a few months, then you would want to have your money in Aussie dollars and not New Zealand dollars. But after the end of this year, you would really want to have your money in New Zealand dollars. So let's take a time frame of just the next few months. Let's say up until the end of this year. Where would you want to have your money? Well, up until the end of this year, we expect the Australian dollar to be stronger than the New Zealand dollar. And we are expecting the British pound to be weaker than the US dollar. So now let's start having a look at some of the other combinations. Let's combine the weakest with the strongest. So we're going to combine the British pound with the Australian dollar. Now, the British pound, we've established, is losing value relative to the United States dollar. And the Australian dollar is gaining value relative to the New Zealand dollar. So we have an interesting interplay of relative value. And when we combine the weakest currency, the British pound, with the stronger of the other two currencies, the Australian dollar, then we get this situation. And this situation tells us that there was a 54-month cycle trough over here. Then there was one 18-month cycle, a very nice, clean, bullish 18-month cycle. Then there was another 18-month cycle, a fairly good neutral 18-month cycle. And now we are in the third 18-month cycle, which is expected to be a very bearish 18-month cycle. Can you see how of all of the analyses we've looked at today, this is actually the best analysis? It sort of jumps out at you. In fact, I see David has said that's a nice phasing. That's right. This is a really nice clear phasing. We've been struggling with some sort of vague phasing in the British pound, US dollar, and the Australian New Zealand dollar. There are a few question marks and so on. But now that we're looking at this combination, we get a really nice clean phasing. I won't bore you with the details, but you'll notice I've used the 2-to-1 harmonic ratio up at the top in the peaks, which is something I find works a lot. I've spoken about already, whereas we have a 3-to-1 in the troughs. So that's an interesting idea that I hope you will play with. So the point is, here we're seeing some really nice, interesting, clear phasing, and the message here is really very clear. We are expecting a move down into this trough towards the end of 2017, as this 18-month cycle completes its very bearish destiny and brings the price all the way down into the end of next year. So having established that the British pound was weak against the US dollar and the Australian dollar was strong against the New Zealand dollar for the next few months, we managed to come up with an even better, clearer phasing here with the British pound to Australian dollar. I see some comments, and I'm going to get to those in a moment, but let's then also do the other thing, which is to compare the US dollar with the New Zealand dollar. Where is that? New Zealand dollar to the US dollar. And now here again, we get a very good, clear phasing. And here we are seeing the inherent strength in the New Zealand dollar. Do you remember that our analysis of the Australian dollar against the New Zealand dollar, the Aussie dollar is going to be strong for a few months, but after that, the New Zealand dollar is expected to get back its strength. And so if we ask ourselves what is the most powerful of the New Zealand or the US dollars, my opinion would be that the New Zealand dollar is currently, or let's say not currently, let's say over the next 6 to 9 months, the New Zealand dollar is going to be the stronger one between the New Zealand and the US. And then, of course, the tables are going to turn, and the New Zealand dollar is going to lose strength relative to the United States dollar. So again, we can go to the other combination. I hope your head is not spinning. This concept of relative value space can get a little tricky, but having just established that the New Zealand dollar is looking stronger than the US dollar into about the middle of next year, we can then look at the British pound against the New Zealand dollar, and here we would expect to see a very clear and very bearish picture as well. And here you can see it. It is indeed very bearish. The British pound New Zealand dollar has dropped down below those lows over there. We again have some fairly nice clean cycles, and we're looking at really some very bearish moves in that particular currency. So that's what I find fascinating about trading in forex, is that once you've analyzed one pair, that you then need to analyze another pair, and then you analyze all the combinations. So we've looked at 4 currencies in today's webinar. We've looked at the British pound, the US dollar, the Australian dollar, the New Zealand dollar. And out of those 4 currencies, of course, we get 6 combinations. And out of those 6 combinations, your task as a Hurst Cycles analyst is going to be to choose the one that has the clearest analysis and that gives you the best possibility of making profitable trades. And I think at the moment that's the British pound to Australian dollar of the next few months. But towards the end of this year, I'm going to be watching the British pound to New Zealand dollar very closely. So I hope that makes sense. There are a few other comments here. I see Peter says it happens on Australian dollar, US dollar, or Chinese dollar. The Australian dollar is getting stronger. Yes, and he also mentions the Japanese yen. That's right. So, of course, I haven't looked at the Japanese yen in today's webinar, because as soon as you introduce another currency, you complicate things even further. There are 6 combinations of 4 currencies. How many combinations are there of 5 currencies? It multiplies pretty quickly. I should know the answer to that, but I'm not going to try it while I'm speaking on air. It's the first lesson I learned. Don't try and do mathematics while you're speaking on air. So it's a really interesting concept that I find particularly useful when you are analyzing forex. You use the concept of the relative value space. In other words, none of these currencies are fixed in value. They're all moving relative to each other. And your duty is going to be to find the best analysis, or the clearest analysis, the analysis that makes the most sense. And then, of course, that's going to be the currency pair that you will be trading. As a matter of interest, I've been working with some people who are very interested in this relative value space concept. And they are putting together a very interesting investment instrument, you could call it, which doesn't in fact trade the forex market, but it consists of opening accounts in multiple currencies. And they're looking at many currencies, the 6 majors and several of the less important currencies, and they open accounts in all of those currencies. And in fact, all that they do is they shift money from one currency to another, and they do it at the moment they're working with roughly a 40-week cycle. So they're tracking the relative value in these currencies and shifting amounts of money between the bank accounts. So it's not currency trading, but the total value of their equity is performing extremely well. And it's a very, very interesting investment model. So I would recommend you take a look at it and come to grips with this concept of relative value space. I find it very useful. I see people saying thank you, and thank you Stan and Blair. Michael says all cycles or currencies are related to the DXY. Any chance of reviewing this? Yes, it's definitely something that we should do, Michael, something I would like to do. I'll add it to the list. I must admit, I did look at the list. We do have quite a few requests for things to analyze, but the DXY is definitely something that I'd like to do. So thank you very much for joining me. Thank you for your interest in Hurst Cycles and Sentient Trader. And I look forward to seeing you at our next webinar, which will be in 2 weeks' time. And in the meantime, I wish you profitable trading and have a good 2 weeks.